Our charts disintermediate reality from the financial news. Similar to what we said yesterday, that you have to separate the signal from the noise. Disintermediation is one of those MBA terms. All it means is that our charts allow you to sort what's actually happening from all the noise, from all the financial news you get out there every day. Why? Because charts are reality. They're showing you what's really going on with price movement. And if you can look at charts and understand what's happening with the weekly vertical crossovers, the signal, the two-day charts, all the different trend lines, the different signals that you see there, then you can tell what's really going on. And the news doesn't confuse. So let's jump into the charts today. What we see going on, remember, markets are not open on Friday, so this is the comprehensive review and forecast for the week that's just passed and for the coming week. So this is our comprehensive review and forecast for the week beginning Monday, the 22nd of April. We see on Thursday, the last trading day of this week, everything is up. Up the most are 20-year bonds, but we see the S&P 500 up quite nicely for the day, 0.20%. And as we start looking at the green candle, we can see that it has finished higher than the prior week. Not a whole lot higher, but higher. And we see that the derivative oscillators gained a little bit of momentum. Price percent oscillators lost a little bit of its momentum. It's no hockey stick, moving over, going down, but it has lost some momentum from that prior week. We go to the two-day chart. What do we see there? Well, remember, the latest two-day candle ended on Wednesday, so we only have a 1 day of a two-day candle here. So it's just we can't make any kind of call on it yet. We can see what it's doing. We can see derivative oscillator losing momentum, price percent oscillator losing momentum, and we can see on our Heikin Ashi candlesticks, remember, Heikin Ashi is different from your typical high-low, buy, and close. What we high, low, open, and close, forgive me. What we see, though, is the way that these candles are measured is that they give us the average pace of what's really going on. And we can see that we have a red spinning top forming, meaning indecision tending down. We can see price just sitting right there on the two-day trend line. Now, the prior two-day candle, price was well above that, so we can see a blowing off. We see it in the derivative oscillator and the price percent oscillator also, still well above the weekly trend line, but losing some energy there, even though it was up for the day. We go to the 4-hour chart. What do we see there? Well, we see the hangover from the prior day on Wednesday, big down afternoon, and then price movement not recovering as high as where it started moving down in the prior afternoon. So that's where we see that weakness. We just can't get a crossover here, can we, on that 4-hour chart for a trigger to get into an uptrade? Market just won't do it. Now, maybe it'll start the week off and do that, but it's not doing it now. Keep your eye on the prize. If the market opens on Monday and it's a big boom up in the morning, and around noon you see a crossover on the 4-hour chart going up, then by all means jump into a practice trade there. But the derivative oscillators gaining downward momentum, price percent oscillators staying away from that red signal line. Not the best moves for the S&P for up movement. And again, some worries by people. The market is topping out. Now, we go to the Qs and we see something different. We see a nice up movement, 3 candles connected. Again, we like to see that on our trend lines. We see the price percent oscillator gaining upward momentum, derivative oscillator heading up also. We go from the weekly to the 2-day. What do we see there? Well, again, we'll have to pull the chart back a little bit to see what we see on the price percent oscillator. It's weakening. Derivative oscillator gaining a little bit of momentum. And of course, what we see going on as far as price movement goes in the latest 2-day candle is it's not moving above where it had been previously. Now, the derivative oscillator is gaining upward momentum. We can see that the price percent oscillator is pretty much flat there. Price movements above the weekly and the 2-day. So again, we're seeing things continuing to move along, but some slowing there. We'll see how this candle finishes off on Monday. And what do we see on the 4-hour chart? Well, we see, again, almost laminated. It's nice we see the derivative oscillator moving up, but we can see with the blow off on Wednesday afternoon, we've still not gotten price as high as it had been back on Wednesday morning. So again, keep your eye on the prize. We are still in negative territory on that 4-hour chart, but our weekly 2-day charts are still moving up, particularly that all-important price percent oscillator, but just watch the market potentially topping off. Maybe it'll bump up strong on Monday. Maybe it'll start crashing. You've done well if you jumped in on this 4-hour chart in the afternoon on Monday the 1st. It has done very, very well for you, somewhere around the 181 range up to a high of 187.93, almost 188. So again, not bad at all over the course of just a few days. So again, keep your eye on things. What has it been, about 2 weeks now? So not bad at all, 5 trading days or so. So looking pretty good and decent. Pay attention, continue. If you want to continue to ride this thing out in that practice trade, no problem. Just watch and see what's happening. Pay close attention, as always, to those 2-day and weekly trend lines once, and all the weekly and 2-day information, particularly that price percent oscillator, after you jump in with a trigger pull from that 4-hour chart. Okay, now we go from stocks to bonds. Bonds up for the day also 0.52%. However, we finished the week with a red, strong red down candle. Again, not even a wick on top like the week before. Price percent oscillator still positive, but heading down. Derivative oscillator is still positive on bonds. But as one would expect, if stocks are doing good, bonds should move inversely. Why? Because bonds are typically a safe haven. If stocks aren't doing good, if stocks are doing good, then people want to get more of a return and go into the market. So what do we see happening on the 2-day chart? First day of this latest 2-day candle with that up move, it's pushing through the 2-day trend line. Derivative oscillator still heading down. Bit of a pull back, as you can see, not heading down at the same strong angle on the price percent oscillator. We go from the 2-day to the 4-hour, and of course, we saw things. We talked about this before, sort of hitting a bottom there around the 122.25 mark or so, and trying to move up at this point. Hasn't penetrated the 2-day trend line on the 4-hour chart, hasn't crossed over. Derivative oscillator did go positive, so just keep your eye on things since we have the 2-day in a confirmed down move, weekly in a confirmed up move. Of course, we don't have a trade on bonds. We're waiting to see how they sort out, and we'll continue to do that. And again, can you use bonds to see when stocks might be weakening, if bonds start getting strong? Again, I tell you all the time, learn everything you can learn from everything that you trade or that you practice trade in, that you watch. Use all sorts of signs and signals. That's why it's so important for you to practice trade year-round and every single day, and that you keep notes and you pay attention to things and you continue to mark your improvement. You know, what's measured and marked responds. You tend to increase your abilities exponentially when you both track what you're doing and pay attention to it. And that's so important. Learn those lessons. That's why we encourage you to fill out your daily market worksheets, weekly market worksheets, trade worksheets. Keep a trader's almanac, your own trader's Bible. So important if you want to supercharge your training and get really good at this. Simply listening to my voice because perhaps it's pleasing to you isn't going to do all that much for you. Sure, you can consider me entertainment. I'm like background noise, but hopefully you're paying attention, you're learning, you're making notes, you're making up your own mind about what you see. So let's keep moving through these charts. Go to our last chart. It's gold. Gold up for the day. The least of all of our charts, 0.07%. Again, gold's in a confirmed down move since that weekly vertical crossover occurred at the end of March, that week ending Friday, the 29th of March. And over the last 2 weeks, particularly over the last 3 weeks, we had a big down week the following week. We then had sort of a green spinning top, a lot of indecision last week. And this week, a nice solid red, decent sized down candle with a wick on the bottom, no wick on top. Derivative oscillator gaining momentum, and it has been for the last several weeks, and the price percent oscillator moving down at a stronger angle away from the red signal line. So again, gold, that down move in gold still in play. 2-day chart, first day of the latest 2-day candle. Again, are we going to bottom somewhere around the 120.20 mark or so? Again, it's right sticking there. We see the market closed a little lower, actually, if I remember correctly, than yesterday. I think it was a 120.55. Could be wrong. That's off the top of my head. Closed at 120.37. So again, what we see happening, derivative oscillator gaining downward momentum, price percent oscillator still heading down. So that's good on the 2-day and the weekly chart. What do we see on the 4-hour? That's what I've been talking about, a little concern about things sort of bottoming out of the 120.20 mark. Let's see how the week starts off. As things start bounding up, you'll pay attention to that on the 4-hour chart, but most importantly, you'll pay attention to the 2-day and the weekly chart and see just how strong the derivative oscillator and the price percent oscillator in particular, how strong they continue. Folks, that's where we are as we end this week early on Thursday for Good Friday tomorrow. Hope that you've enjoyed our comprehensive review and forecast. You are learning what you have learned. You are putting to use what you've learned this last week, getting ready for this coming week. I want you to always make sure you practice trade everything you possibly can. And when you've got questions, problems, concerns, write us, cw@chartingwealth.com. We had a problem over the last week, just under a week. Had all sorts of trouble getting our emails out to you. Appreciate all of you concerned about that. Finally, Ramil, one of my programmers, was able to solve the continued issue. And of course, you've seen those emails showing up again. So thank you so much for your concerns about it. We do appreciate all of your concern on our part. We're happy to get those things out to you. If you've not purchased our book, Ninth Printing, those books are available. We are happy to get one out to you. All you've got to do is follow the link in the show notes to our site where you can purchase that book. If you live overseas, you can't buy the book there for some crazy reason. Square does not allow the overseas folks to place orders, but if you'll email us, cw@chartingwealth.com, we'll send you a PayPal invoice and we'll get your book out to you wherever you are. Folks, that's it for the week. Hope that you all have a happy Easter, great Passover. God bless everyone. Thanks for being with us. We love to hear from you. The whole team here wishes you happy holidays from chartingwealth.com.